I'm Sandy Chadha. I've been CEO and running this business since the age of 19, and it's been a long journey since then. So I want to just tell you a little bit about Supreme. Supreme, for those people that are new to the company, Supreme is a fast-moving consumer goods business. We're a manufacturer, we are a brand owner, we're a licensee, and we're a distributor. And we deal in 4 main verticals, and these verticals normally are in fast-moving markets, are in staple consumer goods that people need to use and replace all the time. Those markets are batteries, lighting, vaping, and wellness. And we have a vertically integrated platform. So how most companies are either a vitamin company or a battery company or a company selling different products, we are one company that sell all different products but under one umbrella, and we have a shared overhead base. And this shared overhead base gives us the flexibility to actually transform our business on a very low overhead base. So basically, we have a range of products, and we use the same finance team, distribution center, manufacturing facility to actually combine the whole business as one. That's pretty much Supreme, and I want to just sort of move on really into the next slide, into the financial highlights. Suzanne, if you want to cover that.
Morning, everyone. Just as an introduction, I'm Suzanne Smith, the CFO, for those of you that are new to this forum. Normally in these presentations, I would take the opportunity about now to walk you through the detailed financial statements, the income statement, the balance sheet, the cash flow. I'm conscious that we've got a lot to get through in the presentation today, and as Sandy said, we want to leave time for Q&A, and the financial statements, of course, are there in all their glory in the RNS. So what I'm going to keep it a little bit briefer so we can really get into the deep dive on the categories. So if we just kind of focus on the financial highlights for FY22, Supreme's first full year on AIM, you'll see that the financial metrics in front of you there are all, without exception, going trending up in the right direction, and we're really pleased with that performance. We've grown revenue in the year by a multitude of factors, new customer wins, the headlines of which being Tesco and Morrison's, and extending distribution into Sainsbury's. We've launched new brands like Sea Lions and Millions our new vitamins brands, and we've also grown via acquisition, and of course the underlying kind of core business has also grown. We've expanded gross margin to kind of 2.5 percentage points, and even below margin, the remainder of the income statement has all moved in the right direction. PBT, net income, EPS have all improved. So a really great solid set of financial metrics. I hope you'd agree. If you recall at IPO, for those of you that have followed the business since it IPO'd 18 months ago, we committed at the time to grow profitability year on year 10%, and that's broadly what we've done this year. So we've delivered on our promise, on the expectation, but more importantly, that growth has been focused on the areas that we know investors attribute the most value, and for us that's vaping and sports nutrition, the categories where we manufacture ourselves here in the UK and we own the brands, and so we have complete control over the supply chain, and they're the areas of our business that are sitting in markets that are growing the fastest. So we've delivered on our growth expectation, but we've grown it more in particular in the areas that we know that investors were kind of guiding us to and leading us to. In growing those categories, as I said, we've expanded the gross margin, and we've done that because those categories are in manufacturing, they're in UK manufacturing. So in doing that, we've also simultaneously reduced our reliance and our exposure to our Far East supply chain, which means that we've reduced our exposure to kind of foreign currency, to freight disruption and freight inflation, and ongoing kind of COVID disruption that we're seeing in China. So that's kind of helping to de-risk our business overall as well. You'll see that we've reduced our net debt position. We're virtually net debt neutral at year end, and we've done that even against the backdrop of servicing our dividend and also acquiring businesses. And all of this has resulted in the kind of net asset worth of the balance sheet virtually doubling year on year. So we're really, really pleased and really proud of the kind of financial status of the business as we drew the business to a close at the end of March. If we then move on to operational highlights, We've delivered on our M&A commitments this year, again, as we set out at IPO. We acquired 2 businesses in the year, both of which were immediately earnings enhancing and fit the blueprint for IPO that we outlined really clearly last year. So businesses that we can add to our platform, businesses where we can own brands, and where we can strengthen or complement our existing kind of consumer offerings in the categories that we already operate in. Since year end, you'll also see that that acquisitions list has been added to. We acquired a business called Liberty Flights just after year end, which again will broaden our product offering into vaping, and we'll talk in more detail about Liberty Flights further on in this presentation. And then even just kind of more widely, again, since IPO, this business has a more robust kind of governance framework. We have more clearly defined and extended our ESG agenda. And we continue to scale out our manufacturing operations. So again, I feel like our operational highlights have delivered really clearly in line with the expectations and the promises that we made at IPO. If we then move on to kind of current trading and outlook, it would, at this point in the presentation, right up front, it would be remiss of us not to be given equal prominence to the outlook for Supreme. The announcement yesterday has outlined quite a sudden and sharp downward trajectory to next year's profitability forecast. And this has arisen within lighting, and we're going to go into some more detail about that imminently as we kind of turn the pages on this presentation, just so that you guys can really understand what's driven this revision to our forecast, and just as importantly, what the longer term trajectory looks like for that lighting category, but also for Supreme in total. But collectively, the remainder of the business is set to grow in terms of revenue and profitability. And what we also want to ensure happens during the next 20-30 minutes is that we also balance this presentation with kind of an outlook on vaping, you know, our fastest growing and our largest category, and what the outlook looks for vaping, because we're a little bit concerned that lighting is going to overshadow the business. And of course, lighting is just 25, this year is 25% of the business. So it's important that you understand what's going on in the rest of the business as well. So Sandy, do you want to jump into kind of the category deep dive?
Yeah, sure. I'll just explain a little bit of background about lighting, and then maybe Suzanne can help interpret what's happened in the category. So this is an area where we license brands. We license Energizer, Eveready, JCB, and we have another license that's pending. We are in this category since 2007. And this category, I've actually this morning said to Suzanne, let's go back to 2000 as far as we've got history and go back to how the lighting category's performed. And it's there from 2012, 4.7 million to 6 to 8 to 9, 14. You can see it's a gradual increase all the way till now. And this is half this business is FOB business. So we have the brand like Energizer, JCB, where we sell straight from China, straight to the retailers in Europe and in the UK, a lot of them being discounters, a lot of them being hardware retailers, that we ship full containers straight to their stores or their distribution depots in Europe or in UK, and we invoice it. And the other half is brought into the UK and sold to thousands of customers around the country. So this is the area where we own the exclusive license outside America for these big brands. And it's an area where it's been a very strong, stable business today. Unfortunately, this coming year, we are estimating a drop of about 40 to 50%, around about 50%, which is astronomically high. And it'd be easy for me to say here, by the way, I lost a customer, or I lost a listing, or this customer's gone bankrupt, and that's the reason why this is a decline. None of those have happened. We've not lost a listing, we've not lost a customer, we've not lost any space. The reason for the decline, and Suzanne can come on to this, is we believe that the last couple of years, there has been a reason that the actual sales were greater than they actually should have been. So the sales in the last 2-3 years probably should have been a little bit lower. Now let Suzanne explain why and where the balancing has come this year and how it's going to be for the next year. Suzanne, do you want to
Yeah. So it's also just important to kind of make it clear that this kind of insight that we're going to share with you now all comes with the benefit of hindsight. This comes with having seen a very sharp and sudden decline and some very disappointing conversations we've had with some of our bigger customers over the course of the last week. It's only in having those discussions and hearing about the orders that frankly aren't going to come through that we've then been able to kind of go back with hindsight, piece it back together and speculate as to what may have caused this. So what I want to make sure is that people don't think that we've been well aware of this and riding this wave of lighting and completely aware that it was going to come to an almighty halt, because that's absolutely not the case. But what we are kind of assuming has happened is that if you look back kind of FY19, FY20, that was as LED lighting was really coming to market and halogen lighting was phasing out. And as we were all going out and buying LED bulbs, which, like for like are more expensive than their kind of their predecessor, the halogen bulb, that drove a surge in sales and a surge in revenue. And just as we were all getting our head around LED light bulbs, then we came into kind of a COVID existence. And our customers, our discount retailers, had really enjoyed that COVID period because they remained open and people bought more light bulbs from those retailers in particular. Then as kind of the initial lockdown phases of COVID ended, then people found, it's well documented, we know that we were doing higher amounts of DIY. We were renovating our houses, we were moving houses, we were replacing bathrooms and kitchens because frankly we weren't spending money on travel or going out. And so with all of that, there has been a fairly prolonged period of intense buying of light bulbs, particularly from our retailers. So what that has meant is that as those buyers within those retailers have continued to buy, they have now been buying on, possibly, I don't use the word false economy, but a slightly exaggerated economy of purchasing, which has meant they have continued to buy from us at that rate. They have now found themselves in a situation where they are overstocked. They have come to us and said that to us, that we're not going to be placing our usual Christmas orders that they'd be placing about now. We're not going to be replacing those with you because we've looked at our DCs and we're sitting on a lot of stock. So that has been one issue, and that has come to light very, very recently, because if you imagine when lighting sales surge, which is as we get kind of in the winter months when we're all using our light bulbs a little bit more, now is when they'd be placing those orders, and that just hasn't happened. What we've also seen more generally across the retail environment is that we think sales are now starting to track about 20% down versus where they were previously. And that's really only come to light in our sales data in the month of June. But then when we've requested EPOS data from some of the retailers, that trend has been setting in for a couple of months as far as they're concerned. Of course, we don't get access to that on a routine basis. And so the actual underlying market, the consumer, is buying 20% less light bulbs than they were this time last year. And so then you ask yourself the question, well, why are we buying less light bulbs? Because we all need to light our homes. There isn't another technology that's coming in to replace light bulbs. And what we have deduced is that off the back of a great year for DIY and home renovations, as people were replacing light fittings or redoing their ceilings with LEDs, then they were buying at that time perhaps a drawer full of bulbs to go with those new fittings that are probably seeing them through this period now. And if you couple that with the fact that there's lots of talk now about kind of cost of living crisis, the profile of consumers that shop in the retailers that we supply, i.e. the discounters, that is a more kind of pronounced impact on that profile of consumers than any other. So if there is a reason not to buy a light bulb, whether there's a reason to not switch their lights on to conserve energy and keep their energy bills down, then perhaps that people are doing that now more than they've ever done before. So whereas if you'd have a light, let's say in your kitchen you have multiple LED fittings and one of those fittings goes and you need to replace it, perhaps people aren't replacing them right straight away. They're not sitting in darkness, they've just got one corner of the room that's not as well lit. And I think we all know, we could all probably speak from personal experience, when one LED bulb goes, it takes a bit of time for us to replace it. Perhaps people are doing that a little bit more. Now that would go some way to explaining why consumer sales have dropped off. And it's not just dropped off in a handful of retailers, it's across the board. It's even across the water in Vendec, our Irish acquisition. They're reporting the same kind of trends. So what we've got in front of us for the remainder of FY23 is that we've seen consumer sales slowing down to the tune of about 20%, but that is massively compounded by an overstocking problem we have in retailers. And that needs to catch up. Now, those two factors will resolve themselves over time. One will resolve quicker. The overstocking we expect to resolve itself within 6 to 9 months. The consumer spending, perhaps 18 months. Let's see what kind of the economic sort of macro climate looks like, and we can all see that. We'll all see that firsthand together. But what we are clear about is, as Sandy said, this isn't a lost customer. This isn't a lost listing. People still need to buy light bulbs. People are still going to shop in those retailers. And the Energizer brand in particular, that sits across a big portion of our category as a brand, is stronger than ever. And it's an exclusive license for us. So people can't go and buy Energizer light bulbs from anybody else. And so what that tells us is that the category will bounce back, and that the reason for buying light bulbs hasn't gone away, and the reason for buying them from us in particular hasn't gone away. What we attribute this to is a pause and a level setting in stocks and a level setting in consumer behaviours.
Just add a couple of things. So the overstocking last year was all compounded by there wasn't any containers and there was a shortage of raw materials. So there's a lot of feast and famine going on last year or so. And the other thing is we were, even though our sales, we think projection next year are going to be 20%, the retailers are going to sell 20% less, the market's huge. So we just need to get 20% more customers to get back to where we were. And one of the customers that was going to list in October, the new license I just referred to, which I can't say the name, we haven't signed, was going to list in October, has now put that back till next April next year. And the reason they put that back is they're overstocked. This is a customer, Poundland, that doesn't buy light bulbs from us. So they've got the same problem, but not with our brands. Also, Asda's going live with Energizer in January. We've also had that confirmation on lighting. So there's good news in lighting as well. Unfortunately, today, it's been a very bad day to explain to you why there's such a big drop today and so suddenly. And you can see in the history since 2012, it's never happened before. So it's not something that we would look for. Have I covered everything, do you think, there, Suzanne?
Yeah, I'm just keeping an eye on some of the questions, and we normally do these right at the end, but the second question that came in was, why no indication in April? On the April call, kind of problem in light, there's a problem in the lighting channel. I'm sure you get weekly sales numbers. That's, I think, something that we would just want to nip in the bud up front. We absolutely didn't know. Somebody asked us yesterday on a call, can you walk us through the last 12 months and how this has kind of come together and what indications you've seen? And I literally said, well, actually, I'll talk about the last 12 days because that's absolutely, it's more apparent. We knew that one of our bigger customers had cancelled some of their FOB lighting orders a few weeks ago, but in isolation, and when you compare that to how our vaping category is performing, which is it's overachieving, the two factors together meant there was nothing to say. And that was an isolated incident. It's only as we have gotten into June and we've started to see our own sales track downwards against this time last year and against budget that it has caused us to quite sharply and suddenly put a call out to all of our largest lighting customers to really understand what's going on. We've requested their EPOS data. Some of them have afforded us the kind of privilege of sharing that with us. Some haven't. Some of us have shared their stock holding, and it's only in piecing that together in literally in the last couple of weeks that the extent of this has become very apparent. Like, we will have conversations and have had conversations. I can hear myself saying it at IPO. The products that Supreme sells, they're really sticky. People need light bulbs, whether it's feast or famine, rain or shine, people need light bulbs. And whilst now, so we sit here questioning how can people just suddenly not? And that's why we're now speculating about macro factors, overstocking, all of these things appear to have happened around about the same time. But what I want to be absolutely clear on is that this isn't something that we have had a sense of, had a feeling about, and either not chosen to share with you or felt we didn't need to. I think one thing that Supreme, we've been given credit for time and time again, and one thing that we pride ourselves on is transparency. That's why we share our category performance, not just at a sales level, but at a gross margin level with all of you in all of these presentations and in our financial statements. If we could give an EBITDA by category, we would do. It doesn't exist because of the way the business is built, because of our single platform. But we're sharing with you everything that we know now, and almost in as good time as we know it, was we knew it. Save getting the board involved, writing this deck, and kind of getting our heads around it. You've known it as quickly as we have.
Yeah, no, absolutely. Suzanne's exactly right what she said. I mean, don't forget, a lot of these orders were coming in the next month for this peak season. Also, I think June is our only month that we've tracked behind, haven't we?
Yeah, April and May.
Spot on.
Absolutely spot on. Yeah. And
Yeah.
actually, in some of the conversations we were having last week, which was, I think we need to put a call into some of our customers. And the sales team here was saying, why are we calling customers and checking with them? We're almost asking them not to place orders, because we were proactively wanting to challenge what their sales forecast looked like before they were perhaps even fully aware of it. But we had to do that because we have to be certain.
Yeah, no, again, any more questions on this, we'll come to the end maybe.
Yeah, at the end.
After. Just how the future looks like. So if you're going to say, what do you think analysts look like in the next year? I don't think it'll be back to where it was. I think it'll be somewhere in the middle of the two, probably more around about 20 million to 23 million revenue next year. But when it comes up, being this vertically integrated platform, we don't have a lot of fat. So when we lose sales of a category and the gross profit, it goes straight to the bottom line. But when it comes back on, it comes back on the top line. So what I'm saying to you is that it comes off as it comes on the same way. So that's one of the sort of downsides, is when you are going a little bit of a decline, like we have seen in this category, it comes straight off the bottom line, and we can't reduce much overhead because there isn't anything to reduce. Okay, moving on to the next category. We'll come back to lighting on questions if you want later. Batteries. Everyone's sort of asking, because this happens to batteries, just so clear, batteries makes about 3.3 million gross profit a year. I mean, what we just announced in lighting is greater than that. So even if we didn't sell another battery for the next year, it will still be less than what's just we announced now. However, batteries still are on plan and look like they're okay. And we won't have the same stocking issue in batteries, because most of the big brands are made in Europe and on a week lead time. And some of our factories from China, we don't actually sell FOB, so the stock comes from us into our customers. So they're only on a 4 or 5 weeks lead time. And obviously that's a lot more clearer, because it's a lot more shorter time frame. So I think we would have a lot more indication of this. At this moment in time, the big brands, the big market leader brands, are tracking between 10 and 15% behind on their sales out on retail. So that's roughly what the market is tracking at the moment, and that is down to just the economic climate at the moment. That's to give you an idea where we are, about 10-15%. But we are tracking on plan of this, and we've had a few good listings as well on this recently as well. There's not much really to say on batteries. I'd like to move on to the next category, wellness. Okay, so wellness. So out of our 4 categories, we've had problems with 2. And this unfortunately, the main problem has been here is the inflation of our products. The price of creatine is tripled. The price of whey is doubled. You get to a point where you can push retail prices up, and they get to a point where at that price in the retail store, they just won't sell because it's just too expensive. And we've seen a little bit of detraction, and we think that our sales are going to be around about the 13 million this year. So come back a little bit. But the problem is the margin has slipped, because we are now making less money than we were, both on vitamins and on powders, because that has also had the same inflation. But however, when this resets and does come down, you'll see this come straight to the bottom line. You know, I'm hoping in the next year or so. Just covering off the protein powders, we've now brought Cymex in-house. We're now producing about 60,000 pounds worth a day in-house of Cymex. We're making reasonably good margin on Cymex now that we're making it, but it would have been far greater had the whey prices not been as high. But we're looking at this as a longer term, plan. This year is going to be really tough for us on raw material prices on this product. But next year and the year after, I'm hoping that it's going to resettle, and hopefully our sales not only grow, but also our bottom line grows and goes straight to the bottom line again. On vitamins, to be honest with you, the millions and millions have been okay. Not been brilliant, but been okay. We've still got listings, but the sales are just okay. On sea lions, we started our advertising campaign again actually today. It's running for this month. There's a gap and then another month, and we're going to spend a small budget every month or every second month on TV advertising. And sea lions, actually, deep under my gut feel, my sense is that this is going to do well. but it's going to take time and it's going to grow slowly and gradually over the next 2-3 years. You develop and launch an e-commerce site. You're not going to get 0 to 10 million in year one. It's not going to happen. You're going to grow, and you can get 0 to 10 million in year one, yes, but the acquisition cost to get there is incredibly high. We've spent very little acquisition cost after our first bout of advertising, and we're running at around about 30 to 35 grand without any advertising a month in sales on Sea Lions at a really decent margin. We think that will now grow to 50, 60, 70,000 with a little bit of advertising. So I think long run, it is growing week on week, month on month. We haven't got a year to year comparison yet because we haven't even started this time last year. So we just need to be patient, but we are investing in that still. I've still got a long desire for that to grow, as well as our Cymex and our protein. And we're fully committed in this area still. I'd like to move on to the next slide. Save the best to the last, I guess. So vaping. I mean, look, this is just an incredible category. It's an incredible market, and we have grown in line with what we said this last year. The year coming, we're looking at we are in now. We're looking at 30% growth. Of which half of that's going to come from an acquisition that we made, which I'm going to cover off Liberty Flights. The other half is purely organic. And we are growing still on our 10 mLs, which is the bottle liquid that we made. But we've also started to, and it's only very, very early days, started to create huge traction on our disposable, which is MPD, which you can sort of see here. The product that you use once and throw away. This product has now got listings in full displays in B&M going in next week. In Poundland, it's there live in 250 stores. It's going to be live in all stores in the next month. In Iceland, in Sainsbury's, in Asda, and in Core Communication. And there's about another 6 or 7 other retailers that is doing really well. And the traction on this week on week is growing at a really escalated rate. We believe that in the next, how many months we've got left in this financial year, we're going to do about 7.5 million of revenue. We think it'll probably even double next year if it carries on. Now, with this disposal, there's a couple of things. It's not affected the 10 ml. The 10 ml is still growing at this 7-8%, and the rest of the vaping category is still growing. This is now coming on as a complementary, and we call in Supreme white space. It's just coming as new. These are now new users that were smoking cigarettes before, found it very difficult to use an open system and not understand it, actually sharing it with a friend and going, oh, this is good, this is helping me stop smoking, and they're going on and buying a disposable. And what we're finding, these disposable users are starting off with disposable, but because it's so expensive, I mean, you're talking £5 or £6 for 2 ml, opposed to £1 for 10 ml. So you can do the maths on how much it is. It's 5 times, well, it's about 5-10 times more expensive, actually more than 15 times more expensive than a 10 ml. So what they're doing is they're starting with a disposable and using them in the weekends they're going out, but then, or at festivals or at parties, but through the week or in the day or in the office or at home, they're reverting back to their sort of their tank and the open system where it's considerably cheaper. So they find there's a bit of a dual aspect going on here. The other part of the market, about 30% of the market, is a pod system, which we are going to come on to with Liberty Flights because they dominate their business in that area, and that's something that we're going to introduce to our customers. We have no customers in common with Liberty Flights. I think one customer out of 600 of their customers is in common with Supreme. This vaping category is not showing signs of slowing down. It's showing signs of anything growing faster than ever. We're growing market share, and the markets are growing. As I sit here today, I'm very, very positive. As I say, this market, this whole climate of economic climate, anything can happen at any time, and we're aware of that. But this is the most resilient and we believe the most stable part of our business and the most exciting and the fastest growing. Just on the other downside on the disposable is obviously not only is it so expensive, it's also not good for the environment. So we are very conscious of that and looking at ways how we can improve that and look at how we can actually get over a system where we can actually collect back the battery. So we are considering how that can work as well. Just if you'd like to move to the next slide, please, Hannah. So yeah, so this is that 43.6 million, if you can see it there, is looking like 60 million in the year we're in now. I mean, 60 million, so it's over half our business, but it's over 65%, maybe 70% of our total profits of the year. And it's the most seamless part. just so you know, we have, ignoring our factory, we have 3 full-time employees that work on 88 or work on vaping. So what I mean to say is that it's so integrated into our platform that we have only 3 employees that just work on 88 vape. The rest are all factory, which is about 170 or maybe 200 employees. But just on this, whereas a sales team sells everything, the buying team buy everything, the finance team, they collect money. It doesn't matter what they buy, they collect the money. That shows how integrated it is, and that shows how much our margin, how we can make such a strong gross margin on this category, where we are the lowest price entry point, yet probably one of the most profitable parts of the most profitable vape companies in the UK, with the lowest price point in the UK, which shows how efficient we are as a company. Suzanne, is there anything to add on the vaping on your side, do you think?
Yeah, I think, and this isn't kind of attached to financial profile, it's more just the backdrop of vaping in terms of government support and sentiment just kind of with the general public, which I think you would argue now is probably more positive and more mainstream than it's ever been before. I'm sure a lot of you will have seen the sort of front page headline back in October when the NHS announced that they would be putting e-cigarettes on prescription, which, you know, as a Supreme has a huge public sector contract with the prisons already to supply vaping, which puts us in a kind of pole position when it comes to taking on that contract. But even if the contract itself doesn't come in our direction, or we choose not to get involved in it, let's see how that kind of progresses. What it does mean, and what it will mean, is that vaping will become more apparent, because people will start on a prescription, but you would expect move on to, you know, a product that they are buying from a retailer, you know, rather than kind of vape on prescription indefinitely. They will move to a product which you would expect, given the extensive distribution we've got. Some of that will be, all of that slack will be picked up by 88 Vape. So that's a positive piece for the kind of market in general. And then more recently, I don't know if anybody picked up on the Khan report, which was a report commissioned just at the start of June, commissioned by the government, which was a check-in to see how the government's objective on its smoke-free by 2030 objective, you know, how was the government tracking? And the report basically said we weren't doing so well, that we were behind, that the government could be expected to be the government should expect the country to be smoke-free by 2034. So we're 4 years behind, and in some of the poorest parts of the UK, probably even further behind. So then the report called for, well, how can we speed that up? How can we accelerate that objective and get back on track? And littered right the way through the report just kept coming back to vaping. So if we're going to move people away from smoking and from cigarettes that cost the NHS 42 billion, I think the latest stat is, the way that people are going to do that safely and permanently is through vaping. So there were calls in the report to lift some of the restrictions when it comes to promoting and advertising vaping. It was to accelerate this prescription-based initiative more quickly and get that in wider circulation. There were calls to, you know, really help sort of dispel some of the myths around vaping, that, you know, perhaps it's just as unhealthy as smoking, which of course it's not. You know, the cancer charities, the NHS have all said it's a 95% safer alternative to smoking. So the report could not have been clearer, and the health secretary was right behind the report, say this is what we need to do if we want to hit this objective, and we are clear this is an overarching objective for the government. So that's really helpful that we're kind of, that the category sits against that backdrop right now.
Thank you. Hannah, the next slide. Yeah, we pretty much, Suzanne just covered that slide.
Sorry, yeah.
Fine, no problem. Yeah, so it's just to reiterate, the government is fully supportive, as we know today. Merger and acquisition. So Liberty Flight. So Liberty Flight is a strategic acquisition. A lovely people that we met back in 2014 when we actually went to them to ask them to manufacture our products for us. I think it was at the time Kick and launching 88 Vape. They looked to see if they could manufacture for us, and so we've had a long-term history with those guys, and they have been really successful over the last 5 or 6 years with this .Pro to pod system. The team there is self-sufficient. It's running Blackburn. It turns over around about 10 million as an annualized turnover. And we believe that we're going to just let them carry on and let them be fully supportive of what they're doing. There's not one customer that is in common. So there's no reason why they can't sell our wider products and why we can't offer their Liberty Flights Pro into our supermarkets, which is probably where it sits better. So it's a strategic acquisition, and it's going to be left alone and to carry on and to grow in its way it's doing in the last few years. There's going to be other acquisitions. I mean, we're going to come into M&A, but there is a handful of acquisitions, and we've got a pipeline of stuff that is more distressed, more not as strategic, but more opportunistic in this sort of area, in the vaping area. But we were looking at, and it's exploring. And if you see that we've cut our dividend policy next year, I mean, the biggest loser for that dividend policy is myself, owning nearly 60% of the shares. But I believe that spending that money in acquisitions and putting it into the business to buy other businesses is going to be far faster growth, and hopefully recover and grow our share price a lot faster than it would be to hand it to myself and other shareholders. So that was one of the reasons for cutting the dividend policy down, is so that we can grow by more acquisitions, because we believe in the next 12 months there's going to be opportunities where there's businesses with lots of debt, there's businesses that are coming to the market with cash flow issues and things that we can maybe acquire. A bit like we did with Cymex, even though that did have a cash flow issue, we bought Cymex on a sort of distressed purchase. And if we can do that, then absolutely great, and that's what we're looking forward to.
We do have a large number of questions, so I shall endeavour to group them together as we go.
We'll try to keep them short and succinct as possible, so we can go through as many as possible.
And I think the first 30 are basically the same question, which we've answered. Why did we not know about lighting? Which I think we covered at the start. But if we need to reiterate it, we can. But I think they're all largely that first few questions coming through.
Indeed. And you've covered off, I think, pretty well there, Sandy, the question around the dividend and your focus there on M&A. Any comment you want to make with the debt from HSBC?
No, I mean, it's 25 million, 35 million of which we just bought Liberty, used part of it for Liberty Flights. It's there empty, ready to use, really.
Yeah, I think one of the questions, and I'm not sure if it's come up here, but it's definitely come up this week, is you've cut the dividend policy. Is that because the sharp kind of downturn in lighting means you've got some liquidity issues and you're not able to service the dividend? The two things are completely disconnected, and we want to make that clear. The reason for cutting or reducing the dividend policy is off the back of investor feedback we've had since day one of IPO, which is you guys are really proficient at M&A. You've proven you have a track record of identifying targets, striking a good deal, and integrating those businesses into your platform. You should be using your capital to do that, and you should be doing more than that, more of that. Our pipeline for M&A right now is probably busier and more exciting than it has been. And as Sandy said, that's perhaps because of the macro climate. It could perhaps because we've been now listed for a year and a half and people know who we are. So there's more acquisitions kind of coming to us proactively. But there's a lot we want to explore, and we want to have the means to be able to do that. We have just got a £25 million facility, but we have just bought Liberty Flights, and we can see that kind of RCF will burn quite quickly if we carry on with the same momentum of M&A. That at the time, that roughly equated to 1 turn of EBITDA. That's now more than 1 turn, given we've just downgraded our EBITDA forecast. This business has historically, and most likely will continue to have, a low appetite for debt. I don't think the business wants to have a really highly geared balance sheet and us be concerned about kind of bank covenants or just or interest kind of obligations. So we're not going to, there's no plan to take on any more debt in addition to the 25 million RCF. We have got a 10 million accordion attached to that facility that's already been pre-agreed that we may dip into. But then you go, okay, so then what? Well, there's cash that the business generates, but we're paying out a dividend at such a rate that from a capital allocation perspective, it just makes sense that buying and building this business, but growing this business via buy and build will undoubtedly generate just a better rate of shareholder return than servicing a dividend. And that was the driver for the decision.
Okay, a few more slightly different questions on lighting. Is there a concentration risk in lighting in terms of your customer base? So,
yeah, the answer is yes. So I would say the top 3 customers is about 35% of the business, but these are long-standing customers for many, many years. And not only the long-standing, they're bought into the brands, but they have what's called proper permanent fixtures in their stores, so fixtures that we put in. So it's straightforward, and we actually give our brands the same sort of cost prices like a private label. So when they put our private label in when they put our brand in like Energizer against the private label, the brand far outsells at a higher price than the private label. So there is concentration, but it is low risk concentration.
I think it's as well, it's perhaps less about customer concentration risk, and it's more the nature of FOB orders. So FOB free on board, meaning we ship it straight from China to the customer, is that they are infrequent, huge orders. So a customer doesn't place one order and it can have it will have a direct impact on profitability, but a sizable impact. One customer doesn't place one order for vaping one particular week. You wouldn't notice, but with these FOB orders, you do. And because of the way that the FOB business works, as Sandy said, it's really low maintenance. It's great business for Supreme because we don't hold the stock. We don't have to pick and pack the orders. We don't even see it. It means then that when you don't get one of those orders, the loss on gross margin translates, unfortunately, down to a loss of EBITDA and even into a loss of cash, because this kind of business just doesn't chew up a lot of overheads and a lot of investment into working capital. So in that sense, it's really great business when it's growing, and it's great business to have, but it also means that the impact is quite sharp then when you lose it.
Okay. Understanding difference then between LED and halogen, can you comment on the sales mix in 2022?
Oh gosh, 2022, it would virtually all be LED, I would have thought. The halogen was banned in 2018. Yeah.
Okay. And then...
Yeah, sorry, go on.
Well, somebody else says you talked there about the surge in lighting sales. I think you did, Suzanne, over the last 2 to 3 years as a result of the move to LED and people doing up their homes. But this gentleman said it doesn't think that the chart you put up showing the growth in lighting revenue would be what you call a surge.
I would agree. I would totally agree, and that's why
that surge translated into your sales.
And that's why it's been even more difficult for us. If we'd have seen a bar chart with it, like we did for batteries, when COVID hit, we saw the bar chart jump up. We went, well, hold on, that's going to come back down, and so we anticipated to come back down. But because it's been over this 3-year period, where the bars have got bigger, and it's only now you go, well, maybe some of that, even though it's only a bar chart that's gone a little bit more, some of that had to be because of COVID and then DIY, or else the downturn that we're having now wouldn't be so marked. But again, we are speculating, and we are in hindsight trying to piece back together. But I'd agree, if it was kind of analytically, you'd have seen it so obviously, we would have been more prepared for it. Would have been prepared for it.
I think in hindsight, what we're saying basically is the last 2-3 years probably we did too much, more than we would have done in normal years. It's probably overinflated by I don't know what percentage, but
no, I wouldn't know.
And just to clear, the guys that run the lighting buying bought shares between our announcement and now openly. I think our main buyer for the battery. So even our main buyer in our company bought shares in Supreme in between our announcement and this in an open period. I think, Suzanne, you remember when you gave permission. But so just so you know, so even people very close to this didn't see this.
Okay. What assumptions are you making now for sort of bulb life and how that will impact sales?
Yeah, so halogen, if you think about halogen moving to LED, halogen lasts about 2,000 to 3,000 hours, and LED lasts between 7,000 and 10,000 hours. It's about 3 times the length. So you're not going to replace it. It's going to be 3 times less frequently. However, it is between 2 times, double the price of what a halogen was to 3 times. So the price of itself is a lot higher. So in theory, the market should decline, but should decline about 20-30%. But we're talking a multi-billion-pound market, Europe-wide, worldwide. It is a huge market, and yeah, it will decline, but by about 15-20%, not at the levels that we've seen it, no way. And we don't believe that ongoing long-term, I think we'll be back on track in the next 2 years to where we were, and then moving forward. I mean, it is a blip, and unfortunately, it's happened as we're a public company 2 years in. Really unfortunate.
Okay. Are you expecting to see inflationary pressure impact that you've seen in lighting to be seen in other categories?
Right, so let's talk about inflationary pressure. Batteries has been about 10%, 15%, which we passed on, which is not too bad. In lighting, funny enough, the prices are all coming down because no one, it's not just us that's not buying, it's the whole of Europe has bought a lot less batteries. So lighting between 5 and 7% has come down in the last month or two, but we've not needed any orders at the moment. Also, just on lighting, we've not got an overstock position. So we have got a position that we are overstocked, but not out of control. It's a couple of £1 million overstock. On the inflation on vaping, it has been more electricity, cardboard, plastic. That's it. It's been very moderate, very small, and I think there was going to be a little sufficient increase in a big increase in vaping inflation. I think we would have known by now, and I think it would have been imminent by now. However, the biggest impact has been the wellness. Anything food related, dairy related, has just gone crazy, and we know that the rates of inflation on the wellness side has been the highest of all our categories put together.
Okay, lots of questions around the same thing happening in batteries and whether you're going to see an overstocking there. Are you requesting EPOS data from your customers on other segments?
Right, so we get all our customers on vaping, we get the EPOS data. And the reason we get the EPOS data on vaping, it's a new category that's got in there, and we requested it from the minute we went in. So we've always had EPOS data on our top 10 customers. That is still measuring and tracking well. We don't get the EPOS data on all our customers. We get it on 2 or 3 of our customers on batteries, and we don't really get it on our lighting because it's FOB. FOB means that our biggest customers buy from China, from our factories, and we supply it from there under the Energizer brand. So we don't really get that EPOS data. But for this purposes, for this, we dug in deep. We got the EPOS for a 4-week, 3-week period, and we got their stock holding, and we pieced it all together, and we did the forward listing. Can this happen in batteries? Well, most of our batteries are sold from the UK. No one's got more than 2-3 weeks stock. So no, I don't think it can happen in batteries. And even if it did, it's only 10% of our overall profits. Can it happen in vaping, overstocking? No, well, I don't think so, because they buy on a week-to-week basis or a month-to-month basis, so they can't be overstocking. Most of the overstocking is FOB from China straight to the customer, where they buy in full containers and they buy as if into their DC for all their stores. It's not from our UK DC. So we have less visibility of it. And the wellness, no, definitely no overstocking on the wellness. If anything, it's the other way around.
Will this change how you deal with lighting customers going forward in terms of the FOB piece?
No, I mean, it works really well. I mean, there's very little staff involved. It works for both parties, the customer and ourselves. I don't think there's anything to change other than reset our customers' levels of stock and then move on. I don't know what more we can do in that area.
Okay, let's take a break from lighting. There's a lot here.
Is it any more important, Martin? Do bring it out, though. I'd rather get it on the table.
I will. I've just got to scan through them all. Looking at the balance sheet, the business is carrying a lot of inventory. What's the shelf life obsolescence risk associated with this?
So let's use that answer that question, but it is mainly lighting for the same reasons, but they don't have a date on it, though, thank God. But, Suzanne?
Yeah, I'll let you answer, but I'll answer. Yeah, Sandy's right. We invested in a couple of things in the build up to year end. So we invested in the raw component of whey protein, which is obviously the key component that goes into our sports nutrition, and that was to protect Supreme from any further price increases. We all saw that whey protein was increasing quite sharply in price. We know that regardless of what mix of particular flavors or brands of protein that we would be selling in the coming months, they all contain whey. So it was a measured risk to buy forward whey protein to insulate ourselves from further price increases. Hindsight tells us that was the right thing to do. And also the volumes that we have purchased as it stands today tells us that was the right volumes to purchase in terms of when we expect to see prices coming down, which is sometime in autumn. So as the year end fell, there were excessive levels of whey protein in stock for those reasons. Secondly, we also had brought more lighting into the business than we'd anticipated, because we saw that raw material prices were set to increase. We had disruption from China, which meant we wanted to make sure we had more onshore than kind of sitting import at China. Maybe that goes back to more of the please trust us that we didn't know that this was coming, because we definitely wouldn't have bought more stocks than less had we seen this coming in any shape or form. The kind of reassuring factor on lighting, as Sandy said, is light bulbs aren't perishable, and be used by date, a sell by date. They don't particularly go in and out of fashion. The only thing that makes a light bulb obsolete is that a newer technology comes into play. That's not on the horizon. The Energizer brand isn't set to rebrand anytime soon. And if it did, would people still buy an old branded Energizer light bulb? Of course they would. So there's no risk from an obsolescence perspective of having excessive lighting stock. I absolutely concur that it's not kind of an optimal use of capital. I'd rather be spending that money on buying a business or investing in vaping. But we are where we are on the balance sheet, but there's not an obsolescence risk attached to it.
Okay, couple of questions on whey price, what's driving this, and what do you see for the future?
Right. So, I mean, what's driving it? I think this the global shortage. I mean, the war in Ukraine has definitely not helped. The prices. I mean, when we started in 2019. £4 a kilo was the cost of whey. We're talking 10, 11 pounds today. That's for 1 kg, and it's a main ingredient in our product. So I guess we're at a point where we hope it's peaked and peaking and coming back down. Again, we're not an e-commerce website where we can pass it on easily. We've got a middleman that's a retailer that has to sell it and make a margin. So it's a lot more harder and trickier for us to keep that margin and pass it on.
And what's driving it? I think it's the law of economics. It's supply and demand. There's a few different kind of theories that is bouncing around businesses like ours about. We've had whey is a kind of byproduct of cheese. We've all eaten less cheese in the last couple of years because of lockdowns, and we're not traveling and we're not eating out. So therefore, there's less whey, but there's just as much demand.
Yeah.
Stuff about China and swine. All sorts. So there's a few different theories, but it's a commodity, and the cost of that commodity has gone up, and then that plays directly into the supply chain, and we're at the receiving end of that.
Okay. Licensing agreements with your lighting products, are they expiring in a couple of years? Are they under threat?
5 years. Both we probably renewed only last year. No, none are under threat, and it'll be the 3rd or 4th time we're renewing. And we've got a great license that we're signing that was going to go into Poundland. Now it's been put back for the reasons of the overstocking that they have as well. And that's another license that we're adding to our bow in the same category. So absolutely no indication of anything at this stage.
Okay. Putting product into Tesco was mentioned last time. Are you seeing any wins there?
So Cymex, it depends which product category. Cymex is listed in there. I think Battle Bites is going in Tesco's. Cymex is going in Costco just now. Is that right, Suzanne? And also,
I think it's going on trial. Yeah,
a trial is in Costco. So we're getting wins all the time. It's good. It's just the margin isn't as good as it's not as fun. When the margin isn't good. But I know that will come when the prices start coming down. We'd rather get the listings and grow the business, and hopefully later it'll come down in price.
Yeah, when we acquired Cymex, we gained access to Morrison's and Tesco. We were in Sainsbury's with Battle Bites, but not extensively. And Cymex gave us immediate access to all 3 of those customers. As Sandy said, we have been in talks with Tesco about their protein snack bar, and that feels really positive. And it's given us an excuse to kind of knock on the door again about vaping. With Morrison's, we've now got a rollout to all stores of a FSDU of vaping. So 88 vape is now very prevalent across Morrison stores, which is a massive win for the group. That's like the best kind of cross-sell that you can get. And Sainsbury's have taken, there've been one-off purchases so far, some clearance lines of proteins, but that kind of wider discussion and that kind of communication is now open with Sainsbury's. So yeah, when these acquisitions bring brand new customers, just like Liberty Flights has done, that opens up opportunity.
Yeah, the Sainsbury's have listed our disposables as well as our 10 ml.
Oh, sorry, disposables, yeah.
And 10 ml, yeah.
Sea lines and millions in terms of the model going direct to consumer, more successful and more appealing?
Yeah, so the sea lions. Sorry, what was the question about more appealing? Sorry, what was the last bit?
Going direct to consumer rather than using your channels.
Yeah, so it's more control. You're on control. I mean, look at our Trustpilot reviews on Sea Lion. I mean, we're in many thousands of reviews already, positive reviews. I just think it's going to take time, and it's going to grow week on week, month on month, year on year. And over a period of time, you go, oh wow, is that big now? Is it? You know, it's going to be one of those. And so we've got full faith in that.
Okay.
Yeah.
Yeah. M&A. What EBIT multiples are you targeting? What areas are you targeting? Let's take those two first, and I'll keep reading.
So multiples wise, I mean, you know, if it's a really established strategic company, 4 or 5 times would be the maximum. If it's a distress, if it's something that's an add-on, the plug-on, we want to get our money back in 18 months.
Okay, how high would you take your debt?
No, I personally wouldn't like more than a year, but Suzanne.
Yeah, so I think we said that we've got our 25 million pound facility. It's got an additional 10 attached to it. It's there. Beyond that, I think we're done. I think we cap out at this point until the business grows significantly, and therefore the kind of debt to EBITDA ratio falls a little bit more in our favor. That's always just been Supreme. We've talked about this when it comes to investing in capex, when it comes to taking on debt, when it's going into new territories. This business is very risk averse in terms of the investments it makes, and that same kind of risk profile is reflected in its kind of policy for debt as well.
Okay, what's the timeline and which areas are most likely?
On M&A, vaping and wellness are the 2 main areas, but mainly vaping at the moment. We've got a pipeline that we're exploring.
Okay, and timeline?
I don't think we can be so specific, but can I just tell you that between these calls, we're trying to do diligence and speak to people, so it is ongoing all the time. So yeah, it's more buoyant and more promising than ever, I think, is probably the extent of what we can say.
Okay, thank you. Do you have any further insight on the timescale of the NHS prescription initiative?
Yeah, they're looking at about 2 years. I'll be honest with you, we're not sure it's right for us, but we're exploring everything. The best thing is explore it, try everything you can, and then make a decision at the end, say, yes, is it worth this? Is it worth the cost? Is it worth doing this or not? So we're in the exploration stage. We think about 2 years, 18 months away, yeah.
Thank you. Will the environmental impact to throw away vaping devices be brought to government attention, and do you expect to crack down on it?
Yeah, no, look, it's a really good question, and it's one thing that niggles us. You know, it's not good, the throwaway vapes, and more people move to the open system, 10 ml or the pod system, the better. I think it's more of an environmental issue. But there's so many disposable things. I mean, look at the water. Yeah, I mean, we're looking at what we can do to help in many areas.
We've been lobbying the UKVIA, the Vaping Association, and we said, what are you doing to put this on the government's agenda? And they have said, we have tried to do the same, but right now they're not interested. It's not on their radar as a problem, so they're not interested in trying to tackle it. So you need to let this kind of flow through kind of economically, that it needs to be around long enough that they say, oh, we've got a problem here. Okay, now we need to fix it. In a non-public sector world, you try to proactively fix a problem before it gathers momentum, but that's not how the government are kind of tackling this. So we're we've been saying to VIA, go and tell them that this is a problem. We need to get ahead of it now. There needs to be battery taxes on it, just like we see in kind of other markets that we're operating in. So that it's not on their radar. They're not interested in wanting to tackle it. So we can't push water up a hill. So we are doing what we can. But unless you've got the firepower of the government wanting to get some support and some direction behind it, it's actually really difficult.
Okay. Given Juul has been banned by the FDA in the US through a temporary stay by the courts, is there a similar risk of regulation in the UK and hence on a break?
Right. So this is a country that bans a brand. So it's like me banning Carlsberg and not Heineken. It absolutely makes no sense why you ban.
Oh,
have you lost
Sandy there? Yeah, I know what he's going to say though, so I'm sure he can drop off.
And not the whole country. I think we've. Second, sorry. Did you hear that? Sorry.
So you just froze. Oh. You froze for a minute.
Okay, am I back now?
You're fine. You're fine.
Okay, yeah. So as I said, this is a country where you can buy guns and cannabis, but not vape. So I think in this country we'll be a lot more. I think we're a little more practical around this, and we are more focused on the health that is saving on lives by giving up smoking. I don't believe there will be a brand ban in this country or anywhere in the world. I can't believe there is one in America. I think that if there is a ban, there is something. It could be, and possibly could be in 5, 10, 15 years around flavors, but I can't see that in the next 5 years.
Well, there was a question here. Any comment on the EU proposed ban of flavoured vaping?
Yes, I think, was that not heat not burn? I can't remember. It was, there was a ban on heat not burn that they're talking about on flavors. Were they talking about certain countries? I mean, I think Denmark or Switzerland was just now reversed it today or yesterday, where they were banning flavors. Now they reversed it. If you want an adult that wants to give up smoking and wants to try a vape pen and is happy to try strawberry flavor because he loves strawberries, why should he or she have to be subjected to the tobacco taste that they're trying to get away from? And also, tobacco isn't that nice as a taste or a flavor. My view is that you should not have anything to do with cartoons or kids' characters on there. You know, it shouldn't be appealing to children. That if there is something, it should be more around that. And if there is children and they do want to go on to smoking or vaping, obviously we'd rather they do neither. You know, they shouldn't do either. But there is a chance that they will do, and the one that they would probably, which is better for them, is vaping. I'm not saying that they should, I'm just saying out the two, it is better for them. And there is a lower upturn of new smoking of youth at the moment, which is really positive news.
All that being said, if the legislation, for whatever weird and wonderful reason, was to go ahead, fruit flavored vaping is in the minority of our sales. The vapes that we sell most of is menthol flavored and tobacco flavored. And actually, if you get rid of all the fruit flavors, which are much smaller production runs, I guarantee our operations manager, whose job it is to manufacture as proficiently and as cost effectively as possible, would do a little dance in the factory, because that means that he can keep his machines running for longer runs. We'd have longer SKUs, we'd hold less stock. Life would be a little bit more simple. But the point that Sandy's making is absolutely valid, that if the government's overarching objective is to get adults or anybody off smoking, by reducing the flavour options, reduces their ability to do that. So it just doesn't make sense.
Yeah, and just 88 Vape, by the way, is not a cool brand. It's a middle-aged brand between anything between 25 and 50. So we are not going to be targeted, hopefully, at the youth sort of thing. That's where Juul got in trouble in America.
Thank you. Back to lighting for a little moment. This problem with suspension of demand, do you think that will feed through into price pressures, and do you have sufficient margin headroom to maintain relationships?
I don't. When you say price pressures, prices are coming down. I don't think in terms of from our factory, and we will pass those on to the customers. We're very transparent. If prices come down, we pass it on. If prices go up, we pass it on, and that works really well. I don't see how the price pressures will come on this. It's a 20% decline in the category.
Yeah, the only way it could come, and we've talked about this previously, is that if consumers are wanting to buy a light bulb but can't afford it, could they trade down to a different, cheaper alternative? We are one of the cheaper alternatives. If anything, there could be some opportunity of people trading down to our brand, but right now, with the view that we're taking, let's not assume any of that. If that comes, that would be some really appreciated upside, but there's nowhere else for them to go. Either they're buying the light bulb at the price we're selling it to them, or they're not buying one.
Okay. Can you be sure that lighting customers are not just going elsewhere?
I can't be 100% sure, but I don't think so. I mean, they're shopping the same customers, the same stores. If you speak to all the brands, all the factories, and all the Chinese factories, and all the brands, and all the competitors, and the lighting association, they'll have exactly the same story we're saying, that it is down. There's been a decline in lighting. In not just lighting, the whole electrical sector, you know, where it's plug sockets. Actually, if you look at Luceco's figures, Luceco is another public company, and part of their category is lighting. They've had exactly the same problem with lighting. They're in control of their own brand on that one. They manufacture their own brand called Luceco.
You mentioned in the release you saw a significant increase in sales at the end of the period, and thus more investment in working capital. What caused this, and in which division were those sales?
That was in reference to debtors being higher at year end than we'd anticipated. No notable trend in terms of who it was or in which category. It was more so our customers typically pay us on a 4-week turnaround. Customers that were buying at the start of the month, which may have paid before the end of the month, actually came towards later in March. Sometimes it can affect just where Easter falls, but there was no kind of rhyme or reason or anything that would be of concern to us. It was just a timing piece.
How are the plans for the new larger premises progressing?
Slowly.
Yeah, slowly and surely. I mean, we want to, you know, we've just given out a profit warning. You know, it's the last thing on my mind at the moment. But we have got discussions and looking at stuff at the moment.
Yeah, as we said earlier, there's we talk about risk appetite a lot. This feels intrinsically like the wrong time to be thinking about new, bigger, fancier places to work. And if we think that our lighting category is going to slow down, then that will free up some space. So that takes the urgency of the requirement to move. We were moving because we were running out of physical storage space, so that the pressure of that kind of falls off slightly. And as we were doing anyway, we are taking our time and to find the right premises, find the right postcode, and make sure it kind of works financially for the business as well. And I suspect that what's gone on in the last kind of 2 weeks will drive us to kind of slow that down even further. But nothing imminent, certainly nothing committed.
What gross margins for vaping, protein and protein powders and vitamin are expected after manufacturing is brought in-house?
Vaping is in-house. So the margins on vaping are kind of mid-40s as it stands. How you see that margin profile kind of track over the next couple of years is less probably about what we do with manufacturing and more about disposables and how big of a kind of segment within the category that becomes, because right now those disposables are manufactured in China and we're simply buying them and distributing them, so the margins there are lower. If sales grow sufficiently, we'll start to see that actually dilute the overall gross margin percentage, of course adding to the kind of absolute gross margin, but that may start to change the mix. But the volumes have to get to quite a level for it to even impact the kind of core 10 ml business. But manufacturing, it's all here, and I don't see that that kind of changing the profile significantly. Sports nutrition, really hard to say, because we are trying to bring manufacturing in at a time when whey prices and kind of creatine and even general raw component prices are rising, and it's hard to know where that will settle. It feels that we are bottoming out that margin right now because all those factors have hit, and the things that will come in the future is that we will do more in-house manufacturing. Whey protein will come down and scaling will happen. So we know that the general trajectory is upwards, but at what rate and how quickly will depend on how those macro factors move.
A couple of questions on price elasticity and price inflation. One in relation to the protein. You're seeing your competitors, MyProtein, Bulk, PhD, have pushed through price rises, but you have not. Why not? And is there an opportunity in other sectors as well to push through price rises?
So the three companies you mentioned there are all e-commerce companies. So they're companies, their customer is the consumer at the end. Our customers are the retailers. So we've got to supply to a retailer who's then got to supply to, so there's a separate margin in the middle. So it's a lot bit easier when you're in control of your consumer at the other end. It's a lot easier to push your prices up, because if you're paying £16 for something, now you're paying £17 for something, it's in control, and you can straight away put it down to 16 the next day if it's not selling. You can put it up to £18 and see how it goes. You can actually play around with if you're an e-commerce business. If you're selling to the retailer, number one, you can't dictate their prices. Number two, you can't dictate their margin. Number three, you can't dictate their space and what they do and what promotions they do. So it's very different. It's not comparing apples and apples.
Thank you. Will you be considering buybacks with the shares at the current level?
So I can't answer that question. I'm not allowed to, I've been told. I'm sorry. I would love to tell you, but I'm not allowed to say.
That's fine. You can go and talk to your board. With LEDs being more expensive and a longer lifespan, wouldn't it be more realistic to forecast a lower run rate of around 7 million? What do they put here? 7 million per annum rather than the forecasted recovery to 20 million category sales in 2024?
So I think Sandy covered off before that, yes, the LEDs last longer, but they cost more. So the net of those two, we'll see that the market will slow down, but not forgetting that we're in distributors and retailers who themselves are growing. So even if the entire market macro might not match our own Supreme sort of trajectory for growth, but yeah, it is factored in.
Thank you. Can you say how many e-liquid units were sold in the full year 22?
62
million, yeah. But that's 10 mLs. Don't forget, we sell hardware, we sell the pod system, we sell the disposables. So there's a lot, and we sell the prisms. So there's it's a portion of our overall business now.
A few questions here on the range of EPS for this coming year. I direct everyone to our research on our website. We've put out fresh forecasts and you'll find the detail there. How is well-publicised recruitment and wage inflation impacting your business?
So inflation, you have electricity going up, obviously transport, wages. Of course, it's having an impact. Individually, nothing. Collectively, it's having. I mean, Suzanne can tell you roughly how much she thinks.
Did you ask about wage inflation specifically then, Hannah?
They did specify that. Yeah.
Wage. Okay, sorry.
Yeah, so we implemented, as every business will have done in our position in April, our kind of cost of living adjustment. Consider ourselves a responsible employer, and so we don't pay at kind of the living wage level. It's slightly above, and like any business, obviously, if we are trying to recruit, then we're seeing that salaries are going up. We're not in a significant investment kind of recruitment phase, so it's not something that's significantly impacting us right now. And we have lots of means in which to incentivize and retain our existing staff. Our Save As You Earn scheme, that is something that we've been able to do since listing, is one kind of feature of that. And we are enhancing our benefits package right now, which we talk about a lot in our annual report. So that there's other ways for us to do that, but it's not something that is consuming us at a management level that we've got a real problem from a financial perspective, or even a kind of loss of staff perspective.
Are you happy to break out the Liberty Flights EBITDA number for the coming year?
The RNS said that the business made 1.5 million of EBITDA last year. We've also said in the RNS that what we do really well is we put businesses together and we synergize as and where possible. Now we've got a great business in Liberty Flights. There isn't a plan to kind of make a huge overhaul. That 1.5 is going to be 3 in terms of a cost base overall, but there'll be some benefits. We're also talking to them more specifically about their supply chain, which is where we think synergies would come from in terms of where they manufacture their pod system. Can we possibly bring that on shore? Can we kind of combine some of the big suppliers so that you can get the rates that we get? So what we expect to see is actually margin expansion rather than overhead savings. The extent of that TBC, but know that as with any acquisition that we do, that's something that we're looking to do quite quickly. So that the 1.5 million that's been published, we would almost certainly expect it to be north of that.
Yeah, and it's growing as well, isn't it? It's on a growth trajectory from the previous year. Quite nice, yeah.
Suzanne, will you be buying shares to demonstrate your confidence?
It's the same.
Comes back to Sandy's previous question of what we can.
The Nomad said that you cannot, because apparently we're not allowed to tell anybody we are thinking about that. I don't know how these things work, but
what I think what we can say, is that we haven't been able to for many, many months because we bounce from one closed period to another because of all the M&A. So we have to be really careful when we can do it, and then in the order in which we do it. Not that I think that me doing it would make a noteworthy impact, given my lack of deep pockets, but that's another matter. But no, we can't. Also,
as you say, because we've got an active progression of acquisitions, we're always in and out of closed periods. So it's not as simple as just say I'll pick up the phone and buy some shares. You've got to go through a whole process with the board.
Thank you. And just Sandy, can you mention again your lighting forecast range for full year 23?
Yeah, I may mention that, Suzanne.
It's in all the published research. And the analysts have guided the market to being kind of a £14 million revenue for FY23. And
if you look at our graph, that takes us back to 2016 or 17. I think it's 2016. It takes us back to where we were in lighting in 2016. So we've gone back like 5 years, but I think it'll jump back within 1 or 2 years quite quickly. Yeah, I mean, we've not lost anything in terms of customers or listings, so that's why it's so hard to explain.
Thank you. I think that largely brings us to the end of the questions. I think we've done a great job there. Thank you for everyone for sticking with us.
The investor website is there. If you've got any more questions that we've not answered, please just pop in there. We'll get back to you.
Great. Well, best of luck for the next.
And also just say I'm feeling pain as well. I'm the largest shareholder, so I'm feeling pain of what's happened in the last couple of days.
Thank you, Sandy. We'll hear from you in the next 6 months, if not before, with an acquisition. Take care and thank you all.